Welcome to Property Showcase, the podcast that brings you closer to the service providers that can inform your decisions about how you buy, manage and research top investment opportunities. Be informed and become a better investor with Property Showcase.
Oh, good day, everybody. It's Tim Neary here, and welcome to the Property Showcase. Today on the show is Paul Glossop from Pure Property Investment. Hello, Paul.
G'day, Tim. Thanks for having me again, mate.
You are welcome. We've got a situation in the country at the moment where we're going into the election. Negative gearing is all the talk. There's also talk of cooling markets. Some markets are cooling, others aren't. My question to you today is, what do the smart investors do at a time like this, where there is a bit of sort of fear creeping into the corridors? What's the best course of action for investors now?
Yeah, you're exactly right. There's probably two big things that are happening right now in the overarching market. One of which is that headlines are being grabbed everywhere to say that the Australian property market is cooling, which probably is a long way from the truth, to be honest with you. But it's most certainly driven by Sydney and Melbourne, which those two markets make up about 2/3 of total transactions. So if they go up, everyone talks about Australian property market being amazing. If they go down, then obviously it's the antithesis, which we're going through right now. So in a market where Sydney's seeing somewhere between 11 to 14% off the boil from about the last 18 months, and Melbourne's probably somewhere around about 10 to potentially 12% where you're looking, we probably think that the bottom of those two markets is going to be found in the next 4 to 10 months, depending on where you're looking and what you're buying. If I look at what the best investors I know have bought through downturning markets, upward trending markets and sideways moving markets, we've got investors who, and we personally are investing quite heavily in markets which we see that the fundamentals are looking exceptional for the next 3, 4 and 5 years. And I give examples of markets which we were buying in, places like Hobart as an example, where 3 or 4 years ago when we started buying in that market, we actually stopped about maybe 18 to 24 months ago, but that was a market which was counter-cyclical at the time and had a very, very good fundamentals of just the initiation of jobs creation, impeccably low occupation as far as vacancy rates that were sitting there, and basically no development that was happening for the best part of the previous 8 years. They're the kind of markets we're looking for that next growth market. All the while, everyone's saying Sydney, Melbourne are going backwards. Yes, they are. And to me, that's a fantastic opportunity as well, because not only are we looking at those markets in parts of, not necessarily Hobart, but parts of Tasmania, parts of the Queensland market are looking very, very attractive at the moment, and even parts of the Perth market we're investing in at this stage as well. We're also keeping a very tight eye on certain aspects of the Sydney market as well as the Melbourne market, because in every downward trend becomes big, big opportunities. So the smart investors I know are being prepared to make sure that they're taking the biggest opportunities when there's the least amount of competition, and B, making sure that their finances are ready to go so they can jump on it, because competition is actually the lowest it's been in that investment space for the most part, probably for the last 5 years. So it's opportunity buying.
It sounds like there was a lot that you said in there, and just to piece it all together, it sounds like at a time like it's really important to have a clear head, separate the headlines from the fundamentals, and have a look and understand that there's sort of the markets within markets, aren't there? And not just take that view of there's one thing happening and follow the line, I guess, of what's being written in the headlines.
Yeah, unequivocally. And to give some examples of the markets within markets, I'll take some examples for Sydney for your Sydney listeners right now, where if you look at data from Bronte as an example, blue chip market, it's gone backwards about pretty close to 20% in the last 18 months. 20%, that's a huge number when you're talking median value is about $3 million. That's hundreds and hundreds of thousands of dollars. But you compare that to other markets, and I can rattle off probably 5 or 6 separate markets, but realistically, I look at markets in areas in the west and southwest, potentially in that sub 750, in that bracket range where they're still affordable for first home buyers. Investors are still there, downsizers are still in those markets, which have basically held their own. They're only 30, 40 kilometres from each other. One's yielding 2%, one's yielding about 4%, one's come off the boil 20%, the other one's about neutral. There's always going to be those cases in any market, whether they're going up in value, downwards or sideways. So markets in markets, absolutely, and understanding what fits your budget and your strategy is always going to be key.
So it's about clear heads, and it's also about being smart and just understanding that there's a range, isn't there? And I guess one person's poison is another person's meat, and understanding where you are and wanting to achieve, and perhaps cherry picking and looking for the opportunities in those markets as they move.
Yeah, unequivocally. And I look at, even if I go further afield to places like Perth right now, where we're buying in certain areas that are in the entry level, areas right through to the blue chip, we've got markets there that have actually grown over the last 12 months in excess of 7 or 8%. And if you look at the headlines, it'll say that Western Australia, again, has gone backwards about 4, 5, 6% in the last 12 months. Well, there's markets in there that we've bought in, but we know of that have probably progressed anywhere between 6 and 8% in that exact same amount of time within a 50-kilometre radius. So knowing why and how is always going to be crucial to actually making money and fitting it to your objectives and your budget.
Keeping a clear head, listening to the pros, watching the fundamentals. If anybody wants to learn more about what we've talked about today, how do they get hold of you, Paul?
Yeah, they can reach out to us at purepropertyinvestment.com. All of our socials always give heaps of up-to-date education, and they can contact me directly via our website and actually book in some time to speak with me directly if they do want to talk about their specific objectives. And as you said, keep a clear head and keep their strategy on tact.
Nice one, Paul. Thanks for your time today.
Cheers, Tim.
Cheers. Our guest on the show today is Arjun Paliwal. Hello, Arjun, and welcome.
Hi, Tim. How are you?
I'm well, thank you. I should say from InvestorKit, and we're going to talk a little bit about property investing today and a couple of insights. We were just talking a little bit off air around some of the things that are going on at the moment. We've got the elections coming up, and we've got some cooling markets. So there's a little bit of sort of working and moving parts that go towards that. People get a little fixated sometimes, or can get a little fixated around where they invest and where they get stuck. And it's your advice, isn't it, not to get too stuck on just investing in your own backyard?
Yeah, well said. I mean, Tim, when I think of investing, the outcome itself is around getting an improved number result at the end of the day. And very easy, can you get in a situation where if prices have risen where you are, for example, Sydney and Melbourne as well to an extent over the longer term, you start to think, well, my money can only now get me a 2-bedroom unit or a 1-bedroom unit. And you compromise on the asset or what you're trying to buy. So when I think of investing outside your backyard, it's almost looking at it from the shares angle, where we could be sitting in Sydney, but we could be buying stocks for businesses in USA, Apple, Facebook, so forth. And it's not like we're walking into the Apple office or the Facebook office each time we buy this stock. So it's just applying that share mentality to property investing.
I really get that. It's a really good analogy, because this property investment is the investment, and it's an asset, and to consider as an asset rather than a home, because that's essentially the separation between the investor and the personal or the principal place of residence.
Correct. So I think when we look at it that way as well, we can start to really pull the emotion out of it. And that's when you start, looking at property and start to realize, hold on a minute, there's never one market. And, very closely what we try to look at InvestorKit is really just bust the myths, break into the numbers, and start looking at markets within markets. And you can even go down from suburb levels to street and neighborhood levels, which is where it gets interesting.
Okay, that's cool. So I like that, bust the myths, look at and get into the numbers. In order to do that, what does that look like? What numbers should investors be looking at? What are the important ones?
So there's obviously the key ones that come to mind around, what's happening out there in the space of infrastructure, population, job vacancies, employment, unemployment. There are a whole bunch of numbers, but I think before the numbers, it's taking a step back and understanding what are you comfortable with. And when I mean comfortability, people suddenly go, well, I only want to invest in capital cities. Or I don't want to invest in regional cities because of so-and-so. So I think before you go into the numbers, it's important to understand how broad your horizon is. And where it comes in terms of myth busting is that capital and regional sort of play. And I think that's an important one to mention when you think of investing outside your backyard. I believe there's about 15 major regional centers, which are in that 100,000 to 1 million in population. So these aren't small places. These are almost parts or chunks of capital cities in one location. And when you're thinking of regions, sometimes the common myths we hear are, look, what about the growth? What about the population? As we know over years, population hasn't had a clear correlation to property price growth. And when you're looking at that, those numbers we talked about, it's about putting together that demand, but also having it look at it from a view of supply and sentiment together as well, that confidence. And so when looking at those three things, regional cities aren't very far apart from capital cities. Incomes in major regional centers are close to actually less than 10% variances than middle and outer ring capital city locations. Sometimes as well, from a few data points that the Regional Australia Institute released, Regional cities actually even have a higher workforce productivity than some of our middle and outer ring capital cities. And so it just really shows that when you're thinking of regional, perhaps don't think of it as I'm investing in Bondi or I'm investing in a CBD. Maybe you're investing into a middle outer ring, and that's where that comparison can truly be made.
What I'm hearing you say, and it's making a lot of sense to me, is that it's all about strategy, and you want to understand, or you want to have an idea of where you're going and where you're starting, and then just put the pieces together. But always keeping an eye on the asset and the fundamentals that I guess that drive that strategy out.
Correct. So I think once you've really casted that broad net to say, hey, you know what? Now that I've looked at the numbers and I have a strategy in mind, I've really noticed that regional and capital cities can form a part of my investment strategy. But when I go deeper into the insights, now I have more options to choose from.
Yeah, absolutely. And Arjun, I wanted to ask you as well, is this just residential property, or have you got some interest, or have you got some thoughts on commercial properties as well?
So that's a great point, because when it comes to property portfolios, a large goal for people is around building a passive income. And if you look at residential property as a whole, when you think of the yields that exist, yes, there are some locations where you can get some higher yielding assets, which in turn create the passive income, but they're largely gross yields. And when you take away council rates, water, insurance, you start to really be left with a little bit of positive income, if not maybe neutral. Moving into commercial, you really start to add passive income as a key piece to your investment journey. And I think for those that want to say, well, I'd like to build a passive income, you have a choice of maybe having a large portfolio, very, very large portfolio of residential properties, which can sometimes even get unmanageable, or you can diversify and maybe substitute a multiple number of residential properties for one commercial asset that can deliver that same income at a lower cost.
And I'm almost hearing people going now, whoa, commercial property, there's a whole lot of other twists and turns involved in that. Is it complicated? Is it more complicated than residential? And if so, is it too complicated?
So it definitely is more complicated. I think it's fair to say that you can't walk in with the same thought or the same measurements and calculations as you did with residential property. But where you can really get that help is at InvestorKit, we specialize in both residential and commercial buyer's agency support. And the key differences are not only looking at from the fundamentals of jobs, employment or incomes and so forth as we do for residential property, but it's actually understanding the industry, the possible disruption, where it's going long term, and then getting very granular down to a lease level. I think the lease is possibly one of the most complicated parts of commercial property, where many people can get right, but also wrong. And that's where that extra support can really be helpful.
That's a cornerstone of it, and that's where you want to get the experts involved. Talking about the experts, if anybody wants to learn more about what we've talked about today, Arjun, how can they get hold of you?
They can visit us at investorkit.com.au, or they can send an email to info@investorkit.com.au.
Arjun, it's been great having you on the show today. Thank you very much for your time.
Thank you, Tim.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.